I'm diving into the crystal ball to predict house prices in 2024 and beyond and put my analysis to the test. And the reason why I'm doing this is to answer a very specific question. Are we entering into an era where house prices will start to rise over the short to medium term? And the reason why I'm doing that is because wealth creation in the property space is not created via rental income, it's created via capital appreciation. And I think, based upon historical trends, that we could be entering into an era whereby you should be buying investment properties because capital appreciation will occur. I might be wrong, but at the end of this video, you should be well equipped to answer that question yourself as well. Let's look at house prices up and down the country, and it's really interesting because house prices do change based on geographical areas. Now, the top 3 performing areas are Northwest at 4.6%, Northeast at 3.6%, and Wales at 1.9%. Now, if you're looking at nationwide, the most recent data coming out of nationwide, house prices are actually minus 1% of 2023 pricing, which is not that much. And according to Zoopla, house prices have actually increased 1.4% this year. So with rates declining, will the impact of that be that house prices start to increase? And later on in the video, I'm going to talk to you about rates and the impact of house prices. But right now, the question that we need to ask ourselves is, A, do you invest now, or B, do you invest later? Now, in order to answer that question, we need to predict the future, but no one can do that, of course. History, on the other hand, can provide us with some clues. Now, when I looked back 30 years, it's really interesting what I found. The base rate in 1994, so exactly 30 years ago, was 5.5%. At the time of shooting this video, it's 5. Now, the base rate dropped to 0.1% and then a high of 7.5% over that 30-year time frame. Now, when we're looking at house prices in 2002 hit a record 28%. But in 2009, they dropped 15%. Now, over that period of time, house prices actually increased 5.88% over a 30-year period. So average base rate, 4.33%. Average house price inflation, 5.88%. Now, when we're looking at the data in a little bit more detail, what we found is that the base rate at 0.1% from 2009 to March 23, house prices actually increased just over 4%. So what is this all telling us? It's telling me that because the Bank of England is slated to drop interest rates further, and the predictions are that the base rate will settle in 2027 at around 3 to 3.5%, that house prices will actually start to increase moving forwards. If you're looking to get into property investing, check out my website, SPV Mortgages. You can book a free discovery call where we will preview with limited company lenders in less than 30 minutes. What is the impact on lower rates on house prices and your ability to borrow? Because they're both intrinsically linked. But if we start with house prices, what tends to happen is if mortgages become cheaper than renting, more people want to buy. That causes a ripple effect in the marketplace from 2 beds, 1 to 2 beds, 3 to 4 beds, and so forth. And it's the supply and demand which causes property prices to increase. Now, that's a really good thing if you already own property assets. You will become wealthier. But if you don't own any property assets, you need to be very mindful of being priced out of the marketplace. Now, let's look at this from a mortgage perspective. As rates start to drop, affordability becomes greater. That's both on the residential side as well as on the investment side. Now, speaking directly on the investment side of things, lower interest rates means that you can borrow more money, regardless of the rental income. Because remember, it's the rental income and the interest rate which dictates how much you can borrow, not your personal income. So as rates start to lower, rentals either stay the same or continue to rise, the amount that you can borrow is greater. But as house prices start to increase, you're going to need to make sure that you've got sufficient funds as a deposit for the stamp duty as well, legal fees, broker fees, etc., in order to move forwards with those acquisitions. A question that I'm asked at my mortgage brokerage almost on a daily basis from every client is which product to move forwards with. Should I move forwards with interest only, repayment, 2-year fixed, 5-year fixed, variable? How should I structure my actual mortgage? So what I did was I decided to do a video all about it. You can watch it here.